Well, welcome to boot camp number 4. Now, before I dig into fine-tuning your asset allocation, I want to make sure you understand what our goal is, and hopefully it is your goal as well. And that is to give individual investors all of the information that they need to be the most productive do-it-yourself investor you can be. That's the goal. And if you haven't watched or listened to Boot Camp 1, 2, and 3, I want you to understand what you've missed to kind of bring it up to date here. In the first of the series, we come to this gigantic fork in the road, and it's simply the question, should I invest in bonds or should I invest in stocks? And obviously, for the long term, we are advocates of the equity part of the market, the stock market. Then, in the second boot camp piece, we talk about what stocks you should be in. And the focus there is focus that we have learned from the academic community. Basically, what are the equity asset classes we could have in our portfolio? We don't have to, but we could use them because their research concludes that those 10 equity asset classes, those 10 groups of particular kinds of companies, large, small, value, growth, etc., that those are all equity asset classes that historically have provided a premium for taking the risk of being in that part of the market. Then, in boot camp number 3, we focus on how you could mix and match those different equity asset classes. In fact, we show you how to use all 10, but then we show you how by using only 2 of the 10, you will get not only a better return historically, but with literally without taking any more statistical risk. And then finally, we come here to number 4. Now, when I say and then finally, I should say, and that brings us up to number 4, because after this, we're going to do a total of 9. Maybe it'll be 10 by the time we're done. But we're planning 9 of these individual boot camp pieces. But in every case, the idea is we have taken somebody to a fork in the road and help them think through it. And in this particular case, the fine-tuning your asset allocation, the fork in the road that we've come to is basically this huge question. How much in equity? How much in fixed income? Now, if you had the right tables, you literally could use those tables to prepare yourself for a lifetime of investing, what is typically called the glide path. And so, as I open up here the first slide, I want you to see, and I want you to see it from 30,000 feet. Do not worry about the individual numbers. We'll get to the individual numbers. But what we have here is a table that reflects the S&P 500. And it reflects, and by the way, this far right-hand column is the S&P 500 without any expenses. And the column right to the left of it is the S&P 500 with the kind of expenses that you would typically pay today to invest in the S&P 500. So you'll see a little difference in those returns. But then we do something that we believe gives you the ability to manipulate this information for a lifetime of investing. Because as a young investor, We would want you to be all in equities. So if your equity investment was to be into the S&P 500, there it is. There is the column of returns for the S&P 500 1 year at a time. You can see the best of times and the worst of times, but no fixed income. But what if you decided, I want my glide path to be until age 40, all equities, and then I want to add 10% fixed income, 10% bonds. Well, we have that column here. And then that's in the column right next to the S&P 500. Now we have that same period of time, but we're taking some money out of this column way over here on the left, the 100% bonds. But we have 10%. So now, when we have 10% in bonds, 90% in equities, the S&P 500, once again, we can then look at what would have happened to my money had I been invested from 1970 through 2024. And as you move to the left, what you're able then to see is adding more 20% bonds, 30% bonds. And finally, again, if you get all the way over to the left, it's 100% in bonds. And you would not be shocked. In fact, if I go to the next column, the next table here, actually, it's all it is basically is the first 10 years. So that you can zero in. This is a little easier to see, obviously. You can see here what happens. Here's the 100% equities. 1970 was not a good year for equities. It only made 4%, the S&P 500. Bonds that year made 15.4%. And by the way, this is a mixture of short to intermediate term bonds. So as you combine them, you'll notice as you add more and more bonds here going to 80, 30, 20%, 30%, 40, and 50, at 50% bonds, that year, because the S&P 500 didn't do well, but bonds did, it was a 10% return for the year. So here's something else important that you see. Notice here under the S&P 500, 2 years in a row with major losses, 14.7% in 73, 26.5% in 74. But if you had been 50-50, you would have been down 4.6% in 73, 10.6% in 74. So every one of these columns allows you to create some what if. And I can tell you that if you really want to understand the trip you're likely to go on, I don't care if you get the what if from us or you find the what if somewhere else. I do want you to see the what if because it prepares you for what could happen. Now let's go down to the bottom of table B1 because this is, I think, just huge. Because what we've done here is show you from 1970 through 2024 the return of these different combinations. So 100% equity compounded at 10.9, 100% fixed income compounded at 6.6. And if we go to the middle of the page, remember when you're 10% equities at 7.1, 20% equities 7.7. See what an interesting thing to see that happens when you add more and more equities. 30, 40, 50% equities is 9.1% compound rate of return. Now that does not start to tell you what the next 55 years is going to look like. It is only to show you that when you add fixed income to the portfolio, that you are changing the risk characteristic and the return. How do we look at the risk? Go down to the bottom of this table. Look at here, the worst 12 months. We looked at every 12-month period starting with January 1970. Then we started the period with February 9th, and then we went right through the months so that it's a whole lot of 12-month periods. And the very worst with the combination of the S&P 500 and these bonds was a loss of 23.2%. On the other hand, for those of you who wanted to try for the gold ring and keep your money in equities your whole, let's say, period during which you're accumulating money, you would have had 10.9% compound rate of return, but instead of a 23.2% worst 12 months, it was a 43.3% worst 12 months. But it gets worse. And when I say it gets worse, the purest way to look at how you might have felt over that 55-year period is what's called a drawdown. And a drawdown for the S&P 500 by itself, the worst reduction in the price is declining, declining, declining until it hits the bottom and then goes back up to where it started this huge decline. And the S&P 500 had a period based on monthly results where it fell 51% before it turned around and got back up to where it started. On the other hand, had you been more conservative, then it would have been 25.5% with half in bonds. And the reason this is also very important is because as a do-it-yourself investor, it is your job to decide. And here's a fork in the road. We'll talk about it later in the series in great depth. When you come to the fork in the road to do it yourself, picking out your own equity asset classes, which might be more than just the S&P 500, or maybe you'll put everything in large cap value. I don't know what you might do, but what I do know is the other path you could take would be to be in a target date fund. And the target date fund adjusts as you get older how much bonds you should have in your portfolio. It does it for you. And that, in a sense, takes you out of the do it yourself into turning this whole thing over to somebody else. And by the way, for most investors, those target date funds are absolutely golden. And you'll find out why when we get into the details. But for those people who want to do it themselves, they want to pick how much they have in stocks, how much they have in bonds early in their investing career. Or they could be coming to retirement and they've got to figure out, okay, I've had my money mostly in equities. Now I'm going to retire. What kind of risk am I willing to take? How much loss am I willing to accept? This is a huge decision because the thing we always fear for you is that you will not, for some reason, be able to stay the course, that you will be spooked by the market. And until you've been through a major market decline, which many of you maybe have not been, I'm talking about being down 50% with all of your hard-earned savings. You may not know where that point is that you would have to jump ship. But this part of the table, and by the way, I want you to notice this, with the S&P 500, there was a worst 60 months, in essence, the worst 5-year period that you would have had a compound loss of 6.7% a year. Now, think how that would feel if during that particular 60-month period, this was your first 5 years in retirement. That would be hugely threatening, I think. But if you were 50-50, the worst 60-month period was basically a loss per year of 1%. I'm not making light of that either, but at least you can see the control you have. This is not up to, if you're not in a target date fund, it is not up to the mutual fund industry to say to you, hey, you better be getting some of your money into bonds, fellow, because there's a big decline in the market that you're going to either face soon or later on, but you're going to face it. And so the better time to have to do something about that for a lot of people is to do it before it happens rather than after it happens. Now, we have many fine-tuning tables. We have a fine-tuning table for every one of the 9 strategies that we lay out on our website, and that we talked about, by the way, in the earlier piece that we did about the sound investing portfolios. So now what we do with the fine-tuning table is we look at just a few of these. And this one, the one at the top, table B2A, is the ultimate buy and hold strategy. And by the way, the ultimate buy and hold does not imply that this is the right one for you. It does imply that it is the one where we used 10 different equity asset classes, each with 10% of the portfolio value. But here's what we know. We know on the far right, that's the S&P 500 with an 11% compound rate of return. Had you used, and of course, in table B2A, which you're not seeing the whole table here, you would see how it did year by year, just the same as you would have seen how you did see how it did year by year with table B1. But in this particular case, notice not a small difference, but the compound rate of return for the ultimate buy and hold 10 fund, half US, half international. And by the way, we also have tables like this for 70% US and 30% international, because a lot of people are not going to want 50% international. But the bottom line is this, that you added 0.9% by having it more broadly diversified. And instead of 9.1% for the 50% position, let me see, 90, 80, 70, yeah, 9.5% for the 50-50, half in bonds and half in the 10 fund strategy. And that before was 9.1. So it was a 0.4% better return. Now, to me, that's a big deal if you look at it over a lifetime. And I can see that if I got a little more aggressive and went to the US 4 fund strategy, 25% each, S&P, large cap value, small cap blend, and small cap value. Takes out the REITs, takes out the emerging market, takes out the other international exposure, and instead of making 11.9, you would have made over this period of time 12.2. And the 50-50 strategy, instead of 9.5, would be 9.8. Now, what I forgot to show you up above here, I forgot to focus on the worst periods. And please notice that the worst period for the ultimate buy and hold 50-50 was a loss of 27.8. That is a little bit more than you would have had with the S&P 500. And if we look at the all equity ultimate buy and hold strategy, that would have been a loss of 58% versus, I believe it was 51%. So yes, you took a little more risk, but you got paid a return that would be substantially better. And when we look at the 4 fund strategy, what is interesting there is that the worst case loss over the draw in regards to the drawdown with the four fund strategy, which got a higher rate of return, 0.3% higher rate of return than the ultimate buy and hold, but the worst drawdown was only 56.8, not quite as low as the S&P 500, but this is a case whereby taking what is perceived to be higher risk, you actually experienced lower losses in the worst of times. And finally, at the bottom of the page, I love what happens here. The two fund strategy, half in the S&P 500, half in small cap value, all US. That strategy had a 12.5% compound rate of return, 0.3% better than the four fund strategy. And its worst 12-month period, I'm sorry, its worst drawdown was 55.8%, even lower yet than the four fund strategy. So at least looking backwards, we can show you an example on that. And I admit the differences are not huge, but they're meaningful over a lifetime. And why did the two fund strategy represent a little bit less risk and a higher return? The lower risk comes because those two asset classes, and we showed this in an earlier boot camp piece, those two asset classes, the S&P 500 and small cap value, are so often at the opposite ends. One is the best, the other is the worst of the four asset classes that we looked at going all the way back to 1928. And so what happens, and they go back and forth from being the best and the worst, which means if you are halfway in between them, you are, number one, having a much less volatile end result, but more importantly, or as important, is that you're taking excess from the one and giving it to the other just about the time that it does better. And so they work beautifully. Historically, we can't know the future, but for 57 years, they have been a wonderful match in terms of combining them to get a good return, but at lower risk, although it's a small amount of lower risk. But again, you can look in every one of these cases. You can, if you wish, you can see how you would have done had you had more money, let's say 50-50 stocks and bonds. In the case of the two fund strategy, that would have been a 9.9% return. In the case of the four fund strategy, 9.8%. And then in the case of the ultimate buy and hold, 9.5%. And as I go to the next page, you'll see, and I'll remind you, it was 9.1%. And the reason I wanted to put these all on one page is because this gives you the ability to compare all of these against the benchmark. And when I call the B1 the benchmark, most people have their equities in retirement in something that looks more or less like the S&P 500, whether it is the S&P 500 or it's some actively managed mutual fund or it's the total market index at Vanguard or Fidelity or Schwab. The bottom line is they're large cap growth driven indexes. So I would like to believe that these other combinations do not expose you to an unreasonable amount of additional risk, but do give you the opportunity for a much better long-term return. Now we have, and I want to go back to 30,000 feet now, we have another fine-tuning table. But this one is different. And I think it is. Remember, I made the case for the combination of S&P 500 and small cap value. So you see on the far left over here, the S&P 500, and the far right, we have small cap value. And in between, we have combinations of those two equity asset classes. Because you might say, there is no way I want to fine tune the equity part of my portfolio in a combination that is 90% small cap value or 80% small cap value. But I might consider 10 or 20% or even maybe 30% small cap value along with the S&P 500. Now let's take a look here at the implications of that, both in terms of risk and return. So here we have on the far right side, small cap value, and you'll notice the 57-year period compound rate of return was 13.6 versus the S&P 500 on the far left at 10.9. Now, here's the magic of this table. And by the way, it's really the same magic, I think, that is in those tables that have to do with bonds and stocks. We now have the ability to test, theoretically, from the past, a long period of over 50 years of data. I can see what happens to my return if I go from 100% S&P 500 to 90% S&P 500 and 10% small cap value. And this is not a minor item. Now, you're not going to see it here, but in the next presentation, boot camp number 5, you're going to see it. It is so obvious because every time we move across this table, you're going to see the results of starting in 1970 and with $1,000 a year, $83.33 a month to make it as real as possible. And what would have happened to my portfolio value if I had used all of these different fine-tuning tables to put money away for the long term? It's a knockout, I think, in terms of a learning tool. But right here, we can just see the raw number of the return, but you'll see it put to work in a real portfolio next presentation. But notice what happens. If you go to 10% in small cap value, 90% S&P 500, you go from a standard deviation of 17 to 16.9. In other words, you don't take any more volatility risk. But the worst 12 months, yes, there's a difference. The worst 12 months for the S&P 500 was a loss of 43.3. For the 90-10, 43.9. Would you even know about that difference? No, I don't think you would. Would you like either one of those to happen to your portfolio? No, I don't think you do. But this is what we have to understand happened in the past. If we look at the worst 60 months, the compound rate of return, as we talked about before, for the S&P 500 was a compound negative 6.7. For the 90-10 is 6.8. And the worst drawdown for the S&P 500 was 51%. If you took the additional risk of adding 10% in small cap value, it was 51.6. In other words, virtually the same. And it is actually possible that either the difference could be wider or it could also be that the worst 60 months was higher with the S&P 500. I mean, the difference is minuscule because they are almost the same. Now, if I push myself to be 20% in in the small cap value, I'm now up to an 11.6% compound rate of return. So I've added 0.7%. Big money, as you'll see next week. And the worst 12 months is now a loss of 44.5, and the worst drawdown is a loss of 52.4, and the worst 60 months was a compound loss of 6.9 versus 6.7 for the S&P 500. And finally, by the time we get to 30%, and the compound rate of return is 11.9, a full 1% more. Now, for those of you who have seen the four tables that show the historical returns of an extra 0.5%, an extra 1%, you know an extra 1% over a lifetime is millions and millions of dollars. Okay? I believe if you put away $6,000 a year over 40 years and then lived off of it in retirement, the difference between of a 1% difference is about $3.5 million, having only invested $240,000. It's huge, huge. And everything creeps up. Now, by the time you get over here to 50/50 S&P 500 and small cap value, you'll see the compound rate of return historically over this 1970 through 2024 period is 12.5%. Now, that's a big deal. And because I don't have a specific presentation about small cap value in the Bootcamp series, I talk about it many times, but I don't do a whole presentation just on small cap value. But I have, of course, done that in the past. In fact, I'll even put a link to one of those in the note field here for this particular piece. But here's what I want you to know, and it is nicely in this column. I want you to see something about the risk and return and who does better how often and how unpredictable that is. What Daryl did in this table, as we look at it now from 1970 to 1979, we have all of those different combinations here in the middle of the page, but way over here on the far right is a wonderful piece of a group of numbers, because what Daryl did here, each year, one of these two equity asset classes, S&P 500 or small cap value, each year somebody made more than the other. They never tied. There was always a winner. Sometimes the winner was a very small difference. Sometimes the winner was a huge difference. He also then created these two columns so that you could see when the S&P 500 wins, as it did in 1970, how much did it win by? What was the difference between the final number? And in 1970, it was 5.4% winner S&P 500. The next year, the winner was small cap value, but only by 0.6%. The next 2 years in a row, S&P 500 was doing better. 11.4 and 15.7% difference. Then, for 6 years in a row, so by the end of the first decade, the small cap value outproduced the S&P 500 7 out of 10 years. But listen to these numbers for those last 6. This is the difference. 8.5, 28.1, 34.4, 29.4, 16.3, 16.7. It made it look like small cap value is that's where you should put all of your money and never look back because obviously it has this huge advantage. Only to find out in the next 10 years, from 1980 to 1989, that small cap value only wins in 4 of the years, and the S&P wins in 6 of the years. Now, to be fair, small cap value won by a lot in those 4 years, whereas the S&P 500 didn't do nearly as well on average. And we'll see that relationship at the end of this table. But now, wait a minute, I've made a mistake. It looks like maybe I should have put the money in the S&P 500 and from 1990 to 1999, if you weren't already convinced, maybe you are now because the S&P 500 wins in 7 years, small cap value wins in 3. Now, again, the 3 years that the small cap value won, on average, it did better. But I will tell you that in 2 of the 7 years that the S&P 500 won, one of those was by 20.9%, and the other was by 35.8. When you see that much difference between two equity asset classes in the same market, what the heck is going on here? What's the secret? How could I know just before this happens that one is going to do almost 36% better? In fact, that was in that year that it did 36% better. Small cap value lost 3.3, I'm sorry, 7.3, and the S&P 500 made 28.5. Boy, I mean, this it is really an interesting challenge. How different these returns can be, and the reason I say they're a challenge is because investors think it means something about the future. We have a recency bias that is so strong that unless you put investing on automatic, the odds are you're going to cost yourself a fortune by second guessing. But as you'll see, that was 2 decades in a row that small cap value was largely outshone by large cap blend. But then the next decade, look at this from 2000 to 2009. In 1 year, in 1 year, S&P 500 wins, and the other 9 years, small cap value wins. Now, this has an impact on the world. For some, the impact is good. For others, it might be bad. But I will tell you that in our investment management company, where I retired in 2012, so I have nothing to do with it other than they still manage our money. But the bottom line is that our portfolios were built for our clients to be half in US and half in international, half in large and half in small. And the small was half in blend and half in value. So whether it was US or international. So during this 10-year period, our clients thought we were geniuses. And this is something we've got to get over. There are no geniuses in this business. There are no geniuses. Even the history of Warren Buffett is not exactly as meaningful as you might think because he had access to leverage that you did not have, or most people did not take. They could have. They could have borrowed. They could borrow half of the whatever amount they had. They could have doubled it with leverage. And there would have been some rough times, but you would have had a much higher rate of return if you survived it. But during this period of time, what did people believe? Oh, small cap value is magic. But would it shock you if for the next decade that it lost its gold ring qualification? No, all of a sudden it's 4 years for small cap value, 6 years for the S&P 500. And what are the experts crying out? The premium for small cap value is gone, never to return because too many people know about it. And when that many people know about it, then the magic is gone. Well, I can tell you, people knew about it in 2000. If I knew about it from the academic community, there were millions of people who knew about it. This is not so unusual. And what we need to understand when we look at these, I want to go back 1 second to 2000 through 2009. Why did small cap value do so well? It may have been reverting to the mean because the previous 2 decades it didn't do very well. In fact, just for what it's worth, even in 1999, people were calling for the death of small cap value. I didn't hear any of them 10 years later saying, whoops, I missed it. But now it's the death. After we see what's happened from 2010 to 2019, I do not see any sign of death for small cap value. And then since 2020, yes, the S&P 500 has done better, but in 2 out of the 5 years, small cap value outperformed. So I think this table is golden. The reason I think it's golden is I'm guessing I'm not going to convince people, particularly retirees, to put half of their equities into small cap value. And that's probably the right thing to do because while you don't see it in this particular period since 1970, if you go back to the Depression, small cap value was worse than the S&P 500 for years. But then when it came back, long term, if you survived, it had amazing returns. Here's what I think it makes it golden. There are people who will say, okay, I'm willing to put 30% in. I'm willing to put 20% in because it looks like I'm going to make a better rate of return, which means maybe I'll get to retire sooner. Maybe it means I'll have more money to spend in retirement. Maybe it means I'll be able to leave more money to my kids and grandkids. All of those are possible. And it's the same, in my mind, it's the same question as how much in stocks and how much in bonds. I'm not pushing anybody at my age to be 50-50, 81, my wife's 77. We're 50-50 stocks and bonds. Vanguard in their target date fund would have you 30% in equities, 70% in fixed income. Nothing wrong with that. BlackRock would have you 40% in equities, 60% in fixed income. Nothing wrong with that. They are just for people who have a difference in risk tolerance. Now, many people don't even know how to measure the amount of money because they've never seen a fine-tuning table. But we know at least about the past. So there you have it. And I want to tell you that what comes next is boot camp number 5, and it is going to focus on fixed contributions. This is where we talk about the risk and the returns and some important information about the realities of how to start your business as an investor and see that business grow and flourish and know step by step how it is likely to play out. because I can tell you and teach you about things that you're likely to face that maybe if you don't learn them, you're not going to be prepared for some of the sad parts of your future and be there then to celebrate the really great parts of how your business does over the long term. Join me next week for that. And as we always have to say, this information is not meant to be personal advice. I cannot give you personal advice. I am not a registered investment advisor. I am a teacher. Chris Pedersen is a teacher. Daryl Balls is a teacher. And we are here to try to share with you what we have learned from the academic community. I want to say this every time if I remember to. There is not one thing that we talk about that doesn't come either directly or indirectly from the academic community. And of course, our job is to continue to educate you, answer your questions. I've had some great questions. They're going to be up on the right pages in the coming weeks. And they'll also be, I think, in the newsletter because I think people like Q&As. And if I only put them on the website, I'm not sure everybody's going to see them. But I need your questions that have to do with each one of these boot camp series because we want to create a Q&A. We were going to do this last year, didn't get around to it, but we want to create a Q&A so that when people come to whatever the boot camp page is, if they have questions, they can scroll down through the questions that have already been asked and maybe answer it without having to go through that again. Okay, it'd be good for us, and I think it would be good for you. I know, by the way, that when I use Chat GPT, it is such a luxury because when I ask it a question about something I don't know a lot about, after it answers the question, it then will ask me, would you like to learn more about, and then it tells me something that I actually hadn't thought about asking, but it is smart enough to know what I should be asking. And it's one of the reasons I love artificial intelligence. And we want to develop some of that right here on our site for you. Thanks for watching. And if you know somebody, I hope you will not only introduce them to the Bootcamp series, this one, but I would like you to introduce them to the whole series. And that link is right on our homepage, kind of on the top line. Thank you for being here today with us. I hope whether you're listening on the podcast or you're watching, that this is helping you be a better do-it-yourself investor. Thank you.